Hey everyone, Mike DeBlis here. Welcome back to the webinar on your Lifeline for Form 8938. We're now up to Module 4 in the webinar series. Here in Module 4, we're going to cover the Form 8938 penalties as well as the statute of limitations. As tempting as it might be to look up in the sky in total exasperation over the maze of Form 8938 requirements and put down whatever comes to mind on a Form 8938 merely to appease the IRS. This, my friends, would be a recipe for disaster. Very simply, it could trigger a number of parade of horribles. And we're going to get into some of those parade of horribles in these slides. Like other penalties in the international arena, the Form 8938 penalty brings with it all the fury of a gigantic tidal wave pounding the shore relentlessly. Now, I realize that that's a powerful metaphor, but it is very appropriate for the type of penalties that a taxpayer faces for failing to file a Form 8938. Let's begin with the first penalty that the taxpayer can expect the IRS to assert upon failing to file Form 8938. Now, there are others. So what we're going to do is start with the first type of penalty and then discuss the others that may or may not apply. Very simply, if the taxpayer fails to file Form 8938 in a timely manner, then he must pay a penalty of $10,000. What does the IRS mean by a timely manner? Well, very simply, by the filing deadline. So if the filing deadline for the taxpayer's Form 8938 comes and goes without the taxpayer filing that form, then he must pay a penalty of $10,000. And as we all know, the IRS is a stickler for enforcing the timeliness of all of its reporting forms, not just the 8938. So even if the form is submitted a day after the due date, the taxpayer still has to pay the $10,000 penalty. Now, of course, there are defenses, and we'll get into some of the defenses towards the end of this webinar. Now we get into the possibility of other penalties that apply. The penalty increases if the taxpayer doesn't fix the problem expeditiously after the IRS brings it to his attention. And the penalty increases not just a little bit, but dramatically in this case. So the string that's attached here is that the taxpayer receives a notice from the IRS about the missing return. Now, this doesn't always happen. As a matter of fact, it's rare that the IRS actually sends a notice to the taxpayer about the missing return. But when it does happen, that's when the possibility of an additional penalties exist. So here you can see a quick and dirty example. Let's assume that the taxpayer does not file Form 8938. And let's assume that the IRS has sent the taxpayer a notice about the missing return. Well, here's how it works. The IRS gives the taxpayer a 90-day grace period to cure the defect. What I mean by cure the defect is to file Form 8938 within 90 days after the day on which the IRS sent the notice. And if the taxpayer does that, then there is no additional there's no additional penalty that applies beyond the initial penalty of $10,000. However, if the taxpayer thumbs his nose in the face of the IRS and does nothing, meaning lets this 90-day grace period lapse without filing a Form 8938, that, my friends, is when the IRS unleashes its holy wrath on the taxpayer. How so? Well, the taxpayer has to pay an additional penalty of $10,000 for each 30-day period or portion of that 30-day period during which he fails to file Form 8938. And the 30-day period, of course, begins after the 90-day grace period expires. As I've already mentioned, this is in addition to the initial $10,000 penalty. However, it's capped at $50,000. So let's discuss this in a very practical hypothetical. For purposes of this hypo, let's assume that there are 30 days in a month. We have a taxpayer. His name is Dan. Dan is a specified individual who has an interest in a specified foreign financial asset. He does not file Form 8938 by the filing deadline. On February 1st, the IRS sends Dan a letter informing him about his missing Form 8938 and advising him that he has until May 2nd, which essentially is 90 days from February 2nd, the day after which the notice was sent, to cure the defect. So these facts are on all fours with this subsequent 8938 penalty, and they give rise to the possibility of the Form 8938 penalty. So we have a few scenarios we're going to work through here. The first scenario, it's May 30th and Dan has still not filed his Form 8938. In other words, May 2nd came and went without him filing Form 8938. What, if any, penalties is Dan subject to? Now, the first thing I'd like to say about this scenario is this. The scenario mentions May 2nd as having come and gone without Dan filing Form 8938. What is so significant about May 2nd? Well, as you might recall from the last slide, the IRS mailed the notice, the Form 8938 notice to Dan on February 1st of that same year. And recall that the 90-day grace period is from the day after the IRS mailed the notice, or begins the day after the IRS mails the notice, and it's a 90-day period. So very simply, we can May 2nd represents the last day of the 90-day grace period, meaning that Dan can cure the defect and file a Form 8938 anytime before May 2nd, or between the time he receives a notice and May 2nd, and doing so will allow him to not have to pay any additional Form 8938 penalty. And if you count the months in your head, you'll see that from February 2nd to March 2nd, that's 1 month. March 2nd to April 2nd, that's a second month. And from April 2nd to May 2nd, that's a third month. So again, assuming that Dan that the IRS has issued this notice to Dan about the delinquent 8938 and that the IRS mailed it on February 1st, Dan would have until May 2nd to cure. Now it's May 30th and Dan has still not filed his Form 8938. So what penalties is he subject to? The first penalty is the initial $10,000 penalty for failing to file Form 8938. There's also a second penalty, and that's a penalty of $10,000 because Dan failed to file Form 8938 within the 90-day grace period. And the first 30-day period beyond the grace period has passed without Dan filing Form 8938. A little hint here, the first 30-day period beyond the grace period is the month of May. So May is the first month that triggers the penalty. And here, if we were to aggregate Dan's penalties just with respect to Form 8938, it would be $20,000. How about scenario number 2? Here in scenario number 2, Dan files his Form 8938 on May 1st. What, if any, penalties is Dan subject to? Well, he has to pay the initial $10,000 penalty for failing to file Form 8938 by the due date. But what about the second penalty, the recurring $10,000 per month special, as you might call it? Is Dan subject to that penalty? He isn't. Why? Because, as we've already discussed, Dan had until 90 days after the day on which the IRS mailed the notice to file Form 8938 in order to avoid the second penalty. The IRS mailed the notice on February 1st. The day after is February 2nd. 90 days from February 2nd is May 2nd. Dan filed his Form 8938 on May 1st. And because he filed it on May 1st, and May 1st falls within the 90-day grace period, Dan does not have to pay a second penalty. Scenario 3. Dan files his Form 8938 on June 15th of that same year. What, if any, penalties is Dan subject to? Well, right off the bat, we know that he has to pay the initial $10,000 penalty for failing to file Form 8938. He's also going to be liable for a second penalty of $10,000 because the first 30-day period beyond the grace period came and went without Dan filing Form 8938. Remember that we emphasized in an earlier slide that the first month beyond the 90-day grace period that triggers the $10,000 penalty is the month of May. And in this hypothetical, Dan doesn't file until June 15th. So a second penalty of $10,000 for Dan's failure to file Form 8938 within the first 30 days after the expiration of the grace period. Expiration of the grace period applies. So now we're up to $20,000 in penalties. But how about a third penalty? A third penalty of $10,000. Does that apply? Yes. And this is where there's some confusion and some people find it hard to wrap their head around. How come? Well, Dan didn't file his Form 8938 before June 30th, which marks the end of the second 30-day period. Well, let me back up for a second. We know here that Dan filed his Form 8938 on June 15th. So the logic, if we're applying the same logic of this draconian rule that the IRS has set out, wouldn't it stand to reason that Dan had until June 30th to file his Form 8938 and not get hit with a second monthly special of $10,000? Well, that's not entirely true. The fact that Dan may have filed his Form 8938 before the full 30-day period, before the full 30-day period came to an end, is meaningless. The rule says, or portion thereof. In other words, a full 30-day period need not pass in order for Dan to be liable for the $10,000 monthly special. This means that Dan could have filed his Form 8938 even earlier than June 15, perhaps June 4th, which would have been just 2 days into the second 30-day period. But he still would have been liable for the $10,000 penalty. So this scenario highlights the concept of portion thereof. A full 30-day period need not pass in order for the taxpayer to be liable for the $10,000 monthly special or recurring fee. As I've already mentioned, Dan could have filed his Form 8938 just 2 days into the second 30-day period, and that would have been June 4th, and yet still have been liable for a $10,000 penalty. And so this penalty definitely packs a 1-2 punch for the taxpayer. In this scenario, Dan is facing $30,000 penalties, $30,000 in penalties. From this scenario, or I'm sorry, we still haven't gotten to the month of December, which, as we know from this scenario, is the month that he finally files Form 8938. However, you can see that I've stopped listing the 30-day periods after October 6th. And why did I do that? Well, the penalty structure in Form 8938 land caps this recurring $10,000 penalty at $50,000. So even though we're still 2 30-day periods shy of December 2nd, we are going to stop aggregating these $10,000 penalties as of October and add up what we have so far, which is $50,000. And again, that's the amount that this penalty is capped at. So even though 2 more 30-day periods passed without Dan filing his Form 8938, the $10,000 monthly special stops aggregating with the 5th month beyond the expiration of the grace period, which here is the month of September. In other words, the 5th month is the last possible month for a $10,000 penalty. Dan's total penalties: $10,000 initial penalty and 5 monthly specials, which aggregate to $50,000 for a total of $60,000. Now I'd like to talk a little bit about the presumption of violation. The combination of Code Section 6038DE and the final regs packs a 1-2 punch by creating a presumption of non-compliance in certain situations. And this is very, very important to understand because not a lot of people are aware that the IRS indulges in this presumption, and that it is legally entitled to do so. So here's an example. Jack is an unmarried specified individual who lives in the U.S. He holds an interest in a specified foreign financial asset which he claims never exceeded the applicable reporting threshold that applies to him at any time during 2013. Let's stop here for a second and let's see if the requirements for Form 8938 reporting apply. We're told that Jack is a specified individual, so you can check the first element off as being satisfied. Second, we're told that he holds an interest in a specified foreign financial asset. So the second criteria of Form 8938 reporting applies. How about the third requirement for Form 8938 reporting, that the taxpayer's interest in a specified foreign financial asset exceeds the reporting threshold that applies to him? Is that satisfied? Well, Jack is claiming that his interest in the specified foreign financial asset never exceeded the reporting threshold that applies to him. And that, my friends, is the third element of an FBAR or of a Form 8938 reporting obligation, that the taxpayer's interest in a specified foreign financial asset exceeds the applicable reporting threshold. Here, the reporting threshold that applies to Jack is $75,000. And if you have a question as to why it's $75,000, then I encourage you to go back to an earlier webinar where we discussed the reporting thresholds vis-a-vis the marital status of the taxpayer, where he or she is located, and the other variables that play into that. But for purposes of this problem, Jack's reporting threshold is $75,000, and he's claiming that his interest in the specified foreign financial asset did not exceed $75,000. So what does he do? He writes a little letter to the IRS memorializing this and telling the IRS that his interest in the specified foreign financial asset was only $40,000, which is $35,000 less than the reporting threshold that applies to him. Now, not surprisingly, the IRS writes Jack a letter back, and that letter might best be classified as a cockroach letter, because it's all but telling Jack to go pound salt. Because what the IRS does is they reject his position. And what they say in the letter is that he has provided insufficient proof that the value of his interest in the specified foreign financial asset is only $40,000. So breaking this down, what we have is a situation where the taxpayer arbitrarily is representing to the IRS that his interest in a specified foreign financial asset is a set amount, but he's not backing that up with anything objective that would confirm or verify his claim that his interest in the specified foreign financial asset is only $40,000. He doesn't attach an appraisal. He doesn't attach a valuation. Nothing objective that would support his claim that his interest is $35,000 less than the reporting threshold that applies to him. And as you can imagine, the IRS isn't going to accept what every taxpayer claims is the value of his interest, hook, line, and sinker, without the taxpayer coming forward with objective proof of the valuation of that interest. And here's what happens in a situation like this, where the taxpayer arbitrarily claims that his interest in a specified foreign financial asset is a set amount. The IRS may presume that the value of Jack's interest in the specified foreign financial asset actually exceeded $75,000 and assert the $10,000 penalty. Now, I'm going to pause here for a second, because the shock waves that this sends, or the chills that this sends up my spine, are just incredible. And the reason why I say that is because it might well be that Jack's interest in that specified foreign financial asset actually is only $40,000. But because he decided to merely write a letter claiming that it was $40,000 without any objective proof to back it up, that's given the IRS carte blanche to rely upon this presumption that the value of his interest in the specified foreign financial asset actually exceeded $75,000. And when the IRS can do that, the assertion of the $10,000 penalty is right around the corner. So again, what is unnerving about this example is how Jack's interest in the SFFA might actually have been what he represented. But because he didn't come forward with objective proof, the IRS can automatically presume that it well exceeded the reporting threshold of $75,000 and assert a $10,000 penalty. As I discussed earlier in this presentation, there are defenses to Code Section 603(a)(d) penalties. One of the major defenses is the reasonable cause defense. And what is the reasonable cause defense? Well, I'll give you a quick and dirty definition of it for purposes of Form 8938. A specified individual who unintentionally fails to file a timely and accurate Form 8938 can have his 603(a)(d) penalties waived if he can demonstrate that the violation was due to reasonable cause and not due to willful neglect. So a couple of things worth noting here. As you can see, this is very straightforward. The specified individual can have his penalties waived if he can satisfy a burden. What is that burden? That he demonstrate that the violation was due to reasonable cause and not due to willful neglect. So we know two things right off the bat. Number one, the burden is on the taxpayer to demonstrate that the violation was due to reasonable cause. Second, we have to know what amounts to reasonable cause for purposes of having this penalty waived. And that, my friends, lies in the cases that have been spawned by this area of the law. So I'm not going to get into specific cases per se, but what is reasonable cause in one area of a penalty assertion may not necessarily amount to reasonable cause in defending against another penalty. So again, you have to be guided according to the case law, and it would be necessary to do some research to determine what reasonable cause defenses held up in court and allowed the taxpayer to get out from underpaying a 603(a)(d) penalty. More on the burden here. As explicitly stated in the final regs, the burden of making an affirmative showing of all the facts alleged as reasonable cause falls on the taxpayer, which in this case is the specified individuals. Now, violations may also lead to other penalties, the most common of which is the accuracy-related penalty. And as you can see here, I've given this slide the title, Penalties Are Doubled in Certain Situations. And what I'm referring to when I say doubled is the accuracy-related penalty. So what is the accuracy-related penalty? The definition of an accuracy-related penalty is that whenever there is a tax underpayment, the IRS may assert a penalty equal to 20% of the amount of such underpayment. And that is provided for in Code Section 6662A. Some of you might be wondering, what is the authority, or what authority allows the understatement of an undisclosed foreign financial asset to serve as the grounds for an accuracy-related penalty? Because at the end of the day, when we talk about understatement in the world of 8938, we are in fact referring directly to an understatement of an undisclosed foreign financial asset. So what has breathed life into the accuracy-related penalty for purposes of Form 8938, failure to report? Here's what has given the IRS the authority to assert the accuracy-related penalty. And I've itemized it in three simple steps. Code Section 6662 lists the items that give rise to a tax underpayment for purposes of the accuracy-related penalty. Step 2, FATCA expanded this list by adding Code Section 6662B7. So thanks to FATCA, Code Section 6662B, which lists the items that give rise to an accuracy-related penalty, has been expanded. All right, so the list of items that could potentially give rise to a tax underpayment have been expanded by FATCA. And what did FATCA add to the list of items that give rise to a tax underpayment for accuracy-related penalty purposes? None other than any undisclosed foreign financial asset understatement. So FATCA merely added to the list of items that already trigger the accuracy-related penalty the undisclosed foreign financial asset understatement. And that, my friends, is how the IRS can now assert the accuracy-related penalty in the context of a Form 8938 violation. Step 3, FATCA also introduced Code Section 6662J. Well, what the heck does Code Section 6662J do or say? It gives us a definition for an undisclosed foreign financial asset. And what it does is it defines that phrase as any asset with respect to which information must be reported to the IRS under various tax provisions, including 603AD, but wasn't. So the combination of all three of these steps is what has given the IRS the authority to assert the accuracy-related penalty when it comes to a Form 8938 violation. And to add insult to injury, Congress has added teeth to Code Section 6662J. How so? Well, it doubles the size of the accuracy-related penalty from 20% of the underpayment to 40% if the underpayment was due to the failure to report a specified foreign financial asset on Form 8938. So the operative phrase here is if the underpayment was due to the failure to report a specified foreign financial asset on Form 8938. If that's the case, then the gloves are off and the IRS will be sure to unleash its holy wrath on the IRS by doubling the size of the accuracy-related penalty from 20% of the underpayment to 40%. Below is an example of when the accuracy-related penalty would be doubled. And this comes from guidance from the IRS in one of its recent manuals. Sean did not report the ownership of his shares in a foreign company on Form 8938, despite selling the shares for a gain, nor did he report the gain on his income tax return. A couple of things to note here. We know based on these two short sentences that John is a specified individual and that he has an interest in a specified foreign financial asset, not merely because he owns shares in a foreign company, but because he sold the shares and those shares resulted in a gain. That's what gives rise to him having an ownership interest in a specified foreign financial asset. Now, in this fact scenario, John did not report the gain on his income tax return, and that was a no-no because that is the very reason for the Form 8938 violation. The fact that he was a specified individual who owned shares in a foreign company, sold those shares, and those shares resulted in a gain that was never reported on his income tax return. So John meets all the requirements for Form 8938 reporting, but did not report the gain on his income tax return. And under these circumstances, the IRS would be justified in asserting a double, or in asserting an accuracy-related penalty that is doubled. So would go from 20% to 40%. Aside from leaving the taxpayer with nothing more than the shirt on his back, this code section can unleash its holy wrath in an even worse way, and that's by taking away their freedom. This is never a pleasant topic to talk about, even in a webinar, but to not comment on it or to discuss it would be to do everyone a disservice. Because at the end of the day, there is always the risk that a violation of Code Section 6038D could lead to potential criminal penalties. How do we know that? Well, a cursory review of the instructions for Form 8938 specifically says, quote, if you fail to file Form 8938, fail to report an asset, or have an underpayment of tax, you may be subject to criminal penalties. So it's not as sweeping a statement as you might have expected. It doesn't say specifically you will be subject to criminal penalties. It says you may. So as in the case of all as in the case of many tax statutes, whether a case gets into the hands or is referred rather to the Department of Justice depends on a number of variables, and in some cases also also relates to the discretion, or actually can be very discretionary in certain cases as well. But needless to say, violations of Code Section 603AD can lead to potential criminal penalties. Extension of the assessment period. This FATCA tornado that has blown in wreaks havoc not just on penalties but also on assessment periods. FATCA modified the assessment period rules in two major ways. First, it modified Code Section 6501C8 to include violations of Code Section 603.8D, and second, it added a new code section to 6501. That is 6501E1A. 6501E1A concerns substantial omissions of income from returns. The general rule: the IRS has 3 years from the time a taxpayer files his tax return to initiate an audit and to propose adjustments. As you are well aware, there are numerous exceptions to the 3-year rule. In fact, many tax professionals are quick to point out that the exceptions nearly swallow up the 3-year rule, so that the instances when the 3-year statute of limitations apply are few and far between. Let's discuss this unlimited assessment period if no Form 8938 is filed. If a specified individual fails to file Form 8938 or files an incomplete Form 8938, then the assessment period stays open indefinitely for the entire tax return. Those last 3 words are huge. The entire tax return. The assessment period for that entire tax return stays open indefinitely and potentially into time immemorial if the specified individual fails to file the form or files an incomplete form. The extended assessment period applies even if the taxpayer's failure to file Form 8938 was a mere oversight. However, if the taxpayer's failure to file Form 8938 was unintentional, then the extended assessment period applies only to Form 8938 and not to the entire Form 1040. So that blunts the possible harsh effect that could come from the taxpayer failing to file Form 8938 or filing an incomplete Form 8938. If the failure was to file Form 8938 was deemed to be unintentional, then the extended assessment period applies only to the form and not to the entire Form 1040. As you can imagine, if the extended assessment period were to apply not just to Form 8938 but to the entire Form 1040, then God knows where that could lead. There could be other items that the IRS finds lurking on that Form 1040 that could result in painful or onerous penalties. And at least here, if the taxpayer's failure to file 8938 was unintentional, then the extended assessment period applies only to Form 8938, which means that 8938 is the form that the IRS is the only reporting form that the IRS could theoretically go back into time immemorial to look at or to assess a penalty for its failure to be filed. So as you can see, this is very subtle, and it's always very important to consult with a tax attorney when dealing with penalties. FATCA also added Code Section 6501E1A pertaining to substantial omissions of income from returns. And what that says here is that the IRS may assess tax within 6 years of the time the taxpayer filed a Form 1040 if two main factors are met. The first is that the taxpayer omits from gross income amounts that otherwise should have been included. And second, one or the other, meaning A or B, applies. The omitted amount exceeds 25% of the gross income actually reported on the return, or B, the omitted amount is attributable to one or more specified foreign financial assets that were required to be reported under Code Section 6038D and exceeds $5,000. If these two factors are met, then the IRS may assess tax within 6 years of the time the taxpayer filed a Form 1040. And so that's how we get to this whole concept of 6-year assessment period for certain income omissions. So it's so important here to take the 3-year statute of limitations with a grain of salt, because as you can see, that is not always true. And the exceptions oftentimes swallow up the general rule that the IRS has 3 years from the filing of a tax return to assess any penalties. So again, be very careful and tread very cautiously when it comes to penalties and whether you have a statute of limitations defense. Once again, I cannot emphasize enough that it's critical to consult with a tax professional. So here we come to the end of this module, and as I've mentioned in other modules, please understand that the information I've assembled for you is general and isn't specific to your unique facts and circumstances. That's why I encourage you to consult with a tax professional to get advice that is specific to your case. If you have any questions at any time, please feel free to give me a call or send me an email. I also have a very active blog, and that is available to anyone who has any interest in this area and is looking for additional information. And that's located at DeBlisLaw.com. Look forward to seeing you in Module 5.